And welcome everyone to another Smart Money Circle show. I'm Adam Sarhan. With me today is Heather Welsh, who's the Senior VP and Wealth Planning Department Leader at Sequoia with over 17 billion in AUM. Heather, thank you so much for taking the time today and welcome to the Smart Money Circle.
Absolutely. Thank you so much, Adam. It's a pleasure to be here.
So Heather, I always like to begin. Can you tell us a little about your story and how you got to where you are today, please?
Absolutely. So as you indicated, currently I'm serving as the Wealth Planning Department Leader at Sequoia Financial Group. We are headquartered in Akron, Ohio. That's about half an hour south of Cleveland. And it may sound very exciting being a certified financial planner, but that is not necessarily always what I dreamed of. Like many little girls, I anticipated being a ballerina when I grew up and really went down that road for a period of time. I spent my summers traveling to New York City, grew up about 30 minutes outside the city, so would go in for dance, actually majored in dance in college. Started with a business minor because dance is a short-lived career, just like any professional sport. And unfortunately, they don't pay you like the NFL. So I always knew there would need to be a, what's the next career? So dance major, business minor at Mercyhurst University. As I was pursuing my undergraduate degree there, found that I really enjoyed the business side and said, let's say this is a double major. And as time went on, ultimately decided to pursue the finance path, did my interviews back east, said starting salary, cost of living, I have a degree that says I'm pretty good at math. Like this is not really adding up. So expanded my geographic horizons. I actually found Sequoia through a recruiter at a campus career fair and got the job here right out of college and have spent my entire career with the firm. Originally started on the advisor track, so very different than the technical planning side. But a year or so in, the market crashed. And that's a really interesting way to begin your career.
Right.
And what I found was our clients really wanted to come back to their financial plan or put one in place if they didn't have one yet. And so those of us in the junior advisor seats, we were called upon to help with that for all of the clients that we were serving. And when the market recovered, Sequoia said, we'd really like to dedicate more full-time people to planning rather than pulling bits and pieces of a bunch of people's time. And I raised my hand and said, I've really enjoyed doing this. I'd like to pivot over here from the advisor path to the technical planning side. And we agreed that it made sense for my skill set and really haven't looked back. Built out my technical skills through obtaining the certified financial planner designation, the accredited estate planner designation, getting my master's through the American College in Financial Services, and ultimately was presented with, thank you, the opportunity to really build out a true department and focus on leading the strategic direction for the planning services we're offering to our clients across the wealth continuum. So it's been an exciting journey. We had about 20 people, less than $1 billion of AUM when I started here. Now we're over 250 team members and over 17 billion of assets under management, 13 offices in 8 states. So it's been an incredible journey. Outside of the office, my husband and I have a 5.5-year-old son. So that certainly keeps me on my toes. And I can appreciate the balancing act that all the working parents have out there with growing their career alongside that parenting journey.
Yeah, there's no question. Mine's set. I have a daughter at 12 and a son at 7. So my hearts go out to all the parents out there as well. It's a lot. All right, so a few questions for you. One, Sequoia, what do you do? What's the overall firm value proposition, if you will? Tell us a little about the firm, if you don't mind. And then please shift a little bit and tell us about your investment strategy and what you do at the Wealth Planning Department.
Yes, so Sequoia overall, we serve clients across the wealth continuum. So, we have clients ranging from kind of your millionaire next door all the way up to your ultra high net worth family wealth clients. And as we've grown, it's enabled our advisors to really specialize in the types of clients that they are working with. So it can really be a built for you experience because the investment needs, the planning needs can vary depending on where you are in your journey, on your overall net worth. So we really take that comprehensive approach to wealth management and really want to get to know our clients to determine how to best tackle their investment strategy. So everything we do from an investment strategy standpoint is 100% built for our clients. We're independent. We use an open architecture platform. So the investments that we're selecting really are in the best interest of our clients. We're not locked into any one fund family, any one platform. We can really be very flexible based on what we learn about what matters most to the individuals we're serving. So getting to understand their goals and objectives, their time horizon and risk tolerance, their income needs. How much are they going to need out of their portfolio? And when do they anticipate needing it? And before we swoop in and say, this is how we think you should be allocated, getting to understand how are they allocated right now? Are there certain personal preferences that they have related to that? Are there a lot of unrealized gains that we need to think about in repositioning the portfolio? What's the need for tax management ongoing? And then armed with that information, we can employ our overall investment philosophy and think about several key principles. One being tax efficiency. We really have tax efficiency at the core of our investment strategy. We want to optimize after-tax wealth within certain risk constraints. And tax does matter, but we want to make sure that we're having smart diversification too. So looking at the global investment landscape and diversifying across many different factors, across geographies, styles, sector, liquidity. In some instances, it's appropriate to mix alternative illiquid investments into the portfolio. So looking at that smart diversification across all those factors. And then when it comes to the great active versus passive debate, we believe that there's a place for both. So in efficient markets where active management isn't necessarily adding a lot of outperformance, we'll seek low cost, perhaps more passive positions in those segments of the market. And then we look for other areas of the investment universe where active management may be able to provide some excess return. And in those instances, select those types of positions for the portfolio. So armed with the details of the individual client, thinking about those investment philosophical principles, our in-house research team can really craft a portfolio that's built for the client and that spans the asset allocation, the risk spectrum, and can really carry them through the market cycle so that we're not constantly having to turn things over.
I love that. And you have a CFP, so you're a financial planner, certified financial planner as well, and you have a wealth planning department on top of the financial advisors. So the advisors at Sequoia come to you for the planning process or the investment side of it. How does that work exactly?
Yeah, so my focus on my team, we are really more on the planning side, but planning and investment strategy, they inform one another. You really can't operate in a silo. So I think that's the power as we've grown, being able to specialize. So our advisors, they certainly have great knowledge in investments, they have great knowledge in planning, but being able to have a full asset management department, a full wealth planning department behind them, it's really kind of that depth of talent on your bench that if something nuanced comes up, you have people that this is what we do every day, knowing the ins and outs of the technical details of the planning software that we use. On the investment side, an in-house team where you have folks that are very specialized in research on real estate versus private equity versus the fixed income markets, and being able to bring those resources all together, to back our advisors up as they serve our clients.
I love that. And then as far as the actual planning versus investments, I know chicken and the egg, is it something along the lines of every year you do a financial plan for the clients, or is it something more quarterly, or how often do you go through the planning, and does planning come first and then investment second, or please speak to that a little bit?
Yeah, I love the chicken or the egg question, Adam, and it really depends on where clients are in their journey when they come to us. It's great if we can start with the financial plan for all the reasons that I mentioned. Having that information can really help us best build the portfolio. But some people really do want to start with just the asset management side of the equation, and that's absolutely fine. So it's one of those, meet them where they are. If people do want to start with the plan, it gives us that really strong foundation to build upon. In terms of how often that's updated, that really depends on the advisor as well as what's going on in the client's life. So as we're having client conversations, I would say there's always probably some planning focused topic that's part of it, even if we're not reviewing the full financial plan. Maybe it's taking a look at the balance sheet. Hey, have they made any new investments elsewhere that we should be accounting for as we think about their global allocation? Were we anticipating that they would be saving a large bonus that was anticipated, and we don't see that in the accounts we're managing? We don't see that in the bank account balances. Oh, okay. You decided to take a month-long vacation to Europe. Sounds like a lot of fun, but
Costs a lot of money.
right. Do we need to take a step back and look at the impact on the financial plan that not saving those dollars might take? So sometimes it's just, the annual refresh, that check-in. And sometimes people are coming to us with very specific questions. I've been presented with this new job opportunity, or, oh, we're going to have another child. What's that look like? Adding in, another round of college costs and daycare. Yeah. So, kind of a client first, advisor driven is what I would say.
Love that. Okay, let's talk about risk. How do you handle risk, and what are some mistakes you see people make with respect to risk management, please?
Yeah, ideally, if we can start with the financial plan, I think that can be a great way to determine risk tolerance, because you can take a look at the impact that different asset allocations might have on your ability to advance your chosen future. Okay. So you can say, well, what if I'm, 50% in stocks and 50% in bonds, or 80% and 20%, or flip that around? What is the impact on my probability of success? And sometimes what we find is a more aggressive portfolio doesn't always equate to a higher probability of success. Sometimes the more moderate portfolio, shows that better success rate because there's less volatility associated with it. Doesn't mean one is good or bad, but can really help people make educated decisions about the risk level that they're taking on. If someone sees, I don't need to take as much risk as I thought, maybe that, really puts their mind at ease and they say, let's go with that more moderate portfolio. In other cases, they may say, well, I'm fine either way. Let's swing for the fences, and I want to try to maximize what I'm leaving to the next generation. It's really about presenting them with the options so that they can make those choices. Because I think that, what happens is if you don't have that foundation, it can just be really tough to stick with it if you're not, seeing what the impact on your long term might be.
Mm-hmm. Okay, so that's a really good point, because you don't want to be able to, if you're expecting to go east and then the wind's blowing west, and then all of a sudden you stop and then you go in a different direction and you keep switching, you get that style drift. You just jumping from strategy to strategy to strategy, and you can't see anything out to the fruition, where if you just stayed the course, you'd be fine.
I think that's exactly right. When you have that long-term vision, it helps so much with that.
Thank you for that, Heather. That's great. So how about some timeless lessons you've learned along the way that you'd like to share with the audience?
Yeah, along the lines of what we were just discussing, investing can really be very emotional. It's so easy to get caught up in the market volatility, in the constant news cycle. And if you have that financial plan to come back to, it really allows you to extend your investment time horizon. When you know where your cash flow is coming from, it's easier to keep that long-term vision in mind than to get caught up in the short-term fluctuations.
Yeah.
It helps you make decisions about, is there anything different I want to be doing with my portfolio? Is this a good time to shift to something more aggressive? Or, what would the impact be if I pulled back? Because I'm really uncomfortable. I don't want to completely jump out, but what if I take a little risk off the table? And also being able to see, are current opportunities a fit for you? So something like in a down market, we may be talking to people about Roth conversions, so that when you move from that pre-tax to that tax-free bucket, your recovery is now tax-free growth. Mm-hmm. That can be really painful to talk about. The market's down, and now you want me to pull money out to pay taxes. It may seem counterintuitive, but when you can see what the long-term impact is, it really helps you take advantage of what can set you up for the best success, and really stay the course.
I love that. So we just met today. It's our first time speaking. I wrote a book. It was #1 on Amazon for about every day for about 3 months. And the whole point of the book, Heather, is to do that. Basically take the emotions out of the decision-making process and learn how to make rational, not emotional decisions. So I absolutely love that. Okay, mistakes. Any mistakes that you see people make, whether not making a plan on the investment side, the planning side, that you'd like to share with the audience, and how do you avoid them?
Yeah, several mistakes that I've observed over the years.
Mhm.
One is abandoning ship, just
Okay.
saying, I've had it, I'm getting out. Because then the challenge is, when do you get back in?
Right.
And there's so many studies out there that, have the data to say, if you miss the start of the upswing, you're really losing a lot of your long-term return. So if you can keep your focus on those long-term goals, I think it really mitigates that tendency to just jump out of the market when the going gets tough.
Mhm.
Another thing I've seen is letting the tax tail wag the dog.
Yeah.
As I mentioned, tax efficiency is really important to how we're managing our clients' portfolios, but it's one of several factors. We're also thinking about smart diversification, like we talked about earlier. So, for example, if you have a really highly concentrated position, let's say you've got a bunch of employer stock from your current employer, your former employer, you may feel very attached to that. And that's okay. You worked hard at that company, or maybe you inherited, some stock that your parent, your grandparent held, and there's some sentimental attachment to that. Certainly I can appreciate it, but we want to make sure that all the eggs aren't in one basket. So getting people to come out of some of those concentrated positions can be a challenge, especially when there's embedded gains. I get it. No one wants to pay taxes, but taking some of that risk off the table can really be important to long-term success. And I think remembering that it's not an all or nothing approach. We are not saying that you need to sell the entire position today. Like I said, I'm about half an hour from Cleveland. I think back to when the Cleveland Cavaliers won the NBA championship several years ago, the all-in theme. You don't have to be all in or all out. So being able to kind of take those chips off the table over time in a thoughtful manner can really mitigate some of this tax tail wagging the dog. And then finally, I'd say the tendency of keeping up with the Joneses. And people might think about that usually in the context of the fancy car, the big house, but I also see it in investment selection. So the hot stock that everybody's talking about at the cocktail party may not be the best fit for your portfolio, even though your friends or colleagues may seem to be in a similar financial situation. There may be something different about your goals that make that perhaps not the right fit for you.
Mhm.
Or if they're talking about some super cool liquid alternative,
Yeah.
if you're a business owner and most of your net worth is a liquid and tied up in your business, that might not be the best fit for you to advance your long-term goals. So take it with a grain of salt. It can be a fun conversation, but what's a fit for your neighbor isn't always a fit for you and your portfolio.
No, I love that. How about some advice? What's the best piece of advice you'd like to give the audience or share with your 20-year-old self?
I would say that changing course does not mean that you failed. Like I shared in a bit of my background, going from dance to business, going from advisor side to the planning side. Clearly, it worked out okay. The fact that we are sitting here having this conversation today, and I often see that with our clients. The only thing that is certain is that life is not going to go exactly as we anticipate.
Right.
So planning is a process. It is not a one-time event. It can evolve with you as life evolves, as unexpected events occur, sometimes within your control, sometimes outside of your control. So coming back to the plan to address, how are these questions going to fit for me, fit for my life? If that's, hey, I need to care for my aging parent and step back from work for a little while. If that is, hey, I want to make a career change. There's so many factors that come into play And it does not mean that you failed if you chose to change course or a roadblock popped up. Can often get around them.
Got it. Well, Heather, thank you so much. It's been absolutely fantastic. What is the best way for people to learn more about Sequoia or get in touch?
Absolutely. So feel free to connect with me on LinkedIn, Heather Welsh, or you can check out Sequoia directly at www.sequoia, financial.com.
Beautiful. Well, Heather, thank you so much. Hopefully we'll have you on again soon.
Absolutely. Thanks so much, Adam.